It's a weak start for the Indian market on the back of weak global cues coming in. The Nifty slips to hover around that 18,000 mark. Most sectors open with losses, although pharma and healthcare gain. The broader market underperforms.
Coromandel enters the drone design business, sets up a wholly owned subsidiary to develop and manufacture unmanned aerial vehicles.
Shriram Finance corrects nearly 10% with heavy volumes as it lists 17.4 crore new shares post the scheme of arrangement with Shriram Group. So maybe some supply pressure.
Promoter group Rising Sun Holdings on a buying spree in Poonawalla FinCorp, with shares worth nearly 125 crore being bought from the open market over the last 3 sessions.
Subdued listing for investor solutions provider KFin Technology. Stock debuts at a marginal premium to issue price and is currently trading 3% lower.
Hello and welcome. You're tuned into Chartbusters. You're on CNBC-TV18. I'm Sonal Bhutra and with me is Mangalam Malu. Mangalam, good morning. Well, turning out to be a bad day for the bulls for sure. It does not look like a year-end for sure. So Nifty at the day's low as we speak, 114 point gone there. And the mid-cap side of things, they are the one which is underperforming today. But if we look at the advance decline ratio, it is not as bad. It is flat, or maybe for around 1,300 stocks in the green. We have around 1,800 stocks in the red right now. So yes, there is a decline, but it is not as bad as we are looking. All the sectoral indices are in the red right now. So there is no green across sectoral indices. Tata Steel, DRL, Sun Pharma, some of these names which are in the green right now. But apart from that, it's a major red.
It is major red, and the fact that we still haven't broken the 18,000 mark is an important one to watch out for, because that is where everyone is positioning themselves for, at least the bulls. There is a jostle between that 18,000 mark, and that is something we'll be monitoring through the course of the day as well. So to further elaborate upon the levels, etc., that we should be looking at, especially given its December series expiry today, we have Rahul Mohinder joining in. Rahul, indices, what would you do for both the Nifty as well as the Nifty Bank and individual stocks?
Good morning, Mangalam. I think, first of all, I'd say that the rally that we had over the last 3 sessions would be more of a relief rally. It wasn't enough to call it a breakout up because the volumes didn't warrant it. My biggest worry, like you said, is breaching that 18,000 level. And to be more specific, 17,950, if that level breaks today, intraday, I think you'll see another fresh batch of selling, which will take the market to about 17,650, breaking which the next level would be as low as 17,200. So I think presently we are in a bit of a bear grip, and there's been a lot of people trying to compare this drop to the drop that we saw in September. And, I think the carnage this time is much milder, because back in September, we fell close to 8% in just about 10 or 11 days, if my memory serves me correct. And I think presently we've taken our time. We've probably from peak to trough not even dropped 6%. So I think there could be a little more pain before things turn around. I'm not trying to suggest that the long term's totally shattered or something like that, but maybe a test closer to that 200-day moving average is on the cards. And my sense is, look, let's conclude of an up breakout when we see some follow through of volume, when we see the market once again clawing back above 18,100. Otherwise, till then, I think we should hold, positions more on the short side. And coming to some stock specifics, let me share some ideas. And, these are heavyweight names, which is what bothers me, is the banking and the auto names look weak to me. We've got more than 90% of the stocks within that Nifty 50 list pointing towards, the red today. And that clearly tells you that this is a bit more secular, than what we've always seen. So ICICI Bank, let's start with that. I would look at going short on the stock, keep a stop loss of 910, targets of 865. Tata Motors, yes, the stock's down a bit today, but I still think there's more pain. We could see newer lows. 370 would be my target on it. 392 would be a stop loss. And finally, if you're looking on the positive side, Tata Steel looks like one that is being resilient and probably could go for more. Buy it with a strict stop loss of 107, targets of 116 on Tata Steel.
Okay, Rahul, thanks a lot for joining us. So those are some technical picks. Could see some more pressure on the markets and the indices as well. With that, let's move on. Shriram Finance is in focus today. The stock is trading lower by about 10% after it issued 17 crore new securities. Vivek is here to tell us what's really happening here and what it means for the stock. Vivek?
Well, that's right. So, it's been one of the sharp downticks that this particular name has seen in today's trading session. So, what we've gathered is that, number one, it's a BSE notice that we are actually highlighting. So, some new shares were listed and they are now available for trading. So, little over 17 crore new securities have been listed. And, what are these securities? These securities, we understand, are the securities that Shriram City Union investors actually got, and these were credited into their account at the close of yesterday's trading session. So, they are now available for transaction from today. So, it appears as though there is selling pressure coming in from that particular set of investors. Now, along with that, what we also understand, we spoke to a couple of analysts, two major shareholders. Number one, Piramal Enterprises, that owns a little over 8% stake in the company, and TPG India, that holds a little over 2.5% stake in the company. Both have earlier iterated their stance that they would like to pare their holding and cash out of their stake that they held in this particular name. So analysts say that this now becomes an overhang as far as Shriram Finance is concerned. So what's actually happened today on very, very high volumes, both on the cash as well as futures market, you're seeing quite a bit of selling pressure coming in. We also understand arbitrage funds are also some of the active sellers in this particular name.
Vivek, thank you so much for putting sense to the decline that we've seen in Shriram Transport Finance. Right from the word go, the stock was lower by about 5%, and now it's extended. It's cut to about 9-odd%. Higher number of shares being credited into the accounts leads to higher supply and some institutional selling that we're seeing as well. With that, we'll step into a short break. But on the other side, we have the management of Arvind Smart Spaces. Remember, the stock was a buzz in yesterday's trading session, up in double digits. We'll get chatting with the management. Kamal Singhal joins in to detail the future plans for the company. Welcome back. There was a recent report which suggested that, the real estate prospects in Ahmedabad are looking extremely bright. In fact, it's also comparing it to the way Hyderabad was, say, about 7 to 8 years ago. Thereafter, we saw a big jump in real estate prospects for Hyderabad, primarily on account of demand coming in from the IT sector and new businesses. So a company that has a fair amount of exposure to Ahmedabad is Arvind Smart Spaces. How much is it likely to benefit, and is there, any truth to that report? We do have with us the management. Mr. Singhal joins in. Kamal Singhal, thank you for joining in, Mr. Singhal. And first up, season's greetings to you, your team, your family. Interactions suggest that, Ahmedabad can be compared to Hyderabad, what Hyderabad was, say, 7 to 8 years ago. What rate do you project the Ahmedabad real estate, both commercial and retail, to grow at going forward? And how much of that would come directly to you?
Good morning, and thanks for the wishes, and wish you same. Ahmedabad is seeing a lot of activity, a lot of action, especially in the post-COVID period. We did see a little bit of a downside during COVID, etc. But I think the industry has shaped up very, very well. Comparing with cities like Hyderabad is one way to look at it, but if you were to look at the city in isolation per se, I think quite a few building blocks have been put in place when it comes to commercial real estate in Ahmedabad. Traditionally, Ahmedabad is more focused on residential. There is quite a bit of activity, innovation, products, etc., which keep coming in that segment. But commercial real estate has been little on the lower side as compared to cities like Bangalore, or even city like Pune, etc. And Hyderabad, of course, picked up a few years back, as you said. But now it seems, sorry.
So, I just wanted to understand from a point-to-point perspective, what has been the price appreciation in Ahmedabad from pre-COVID to now, and what is expected going forward, both on residential as well as commercial?
Residential has seen a great traction in prices and uplift both. Maybe in excess of 10 to 15% on a CAGR basis. Commercial real estate prices have been pretty stable. We've not really seen a very significant jump in both prices and rentals. They are stable, or maybe a little on the lower side now, because supplies have really seen up and consumption is now catching up. So commercial real estate prices are stable. Residential has seen a very, very healthy trend of around 10 to 15% of growth in the last 2 quarters or so.
Okay, so that's interesting, and that would be favorable for developers like yourself because you do have a substantial exposure in the Ahmedabad market, Mr. Singhal. But can you tell us what is the total market share that you have? Because yes, a lot of real estate players are coming up there via JVs or joint developments as well. And will this be the focus market for you, which will continue to be the focus market? You are in Bengaluru and Pune, but any other markets that you're tapping?
Yeah, sure. So Ahmedabad, we as a company are focused on residential. We don't do commercial much or retail much. And our focus remains in the medium term and long term on residential segment itself. There we have a very, very strong presence in Ahmedabad and Bangalore, both these cities, and we've just entered Maharashtra, MMR, and Pune, etc. But yeah, we are seeing the benefits. We are seeing a great amount of traction. We've launched a couple of projects in the last couple of quarters, and the uplift has been great and beyond expectations. So we feel very confident and we feel very happy about the way the markets are behaving in both these cities.
So the Ambit report says that 16,500 residential units are sold annually in the Ahmedabad market. What would your proportion be in this?
So we are targeting to be somewhere around 15% of the market, generally speaking, in the segments that we operate in. Of course, the 16,000 is a big number in the sense of so many product segments being there. We are mainly focused on horizontal development in the city of Ahmedabad, which includes plotting, villas, etc., etc. And there we intend to corner a very healthy two-digit share in the marketplace.
So what exactly then is the launch pipeline looking like? I mean, can you split it up for us into affordable, mid-housing, luxury? And when you say 15% of your addressable market, what would that mean in terms of unit sales? Would that be about 2,000 units or a little under that?
So this year we should be selling somewhere around maybe little less than 1,000 odd units to say. This year our focus has been on horizontal, as we said, which includes plotting and villas. We have launched a couple of projects already in this segment in this year, and we are intending to launch at least one more in the city of Ahmedabad. We've launched a couple of projects in Bangalore this year, and the idea is to launch one or two more projects in that city as well. So all in all, 4 to 5 project launches this year, practically everything in horizontal space, which includes plotting and villas.
Okay, so that takes me to the next question as to how will you be funding it, this pipeline that you have in place, of course, big launches planned. Will it increase your debt because right now you're net cash?
Yeah, the company is net cash, as you said. As of 30th September, there was no debt. Rather, we were a cash positive company that day. And we have tied up with HDFC, as you know, through 2 different platforms. Platform 1 is over. I mean, investments are over there. Right now, we're in the middle of investing in platform 2, which is a 900 crore rupees of platform. There, HDFC brings in 600 crores, 2/3 of the money, and 1/3 is supposed to be brought by Arvind. So all in all, 900 crores come from that source of funds. And we have very, very strong internal accruals happening in the last few quarters, so that remains another. Because the company is debt free, of course, there's a very significant headroom to raise additional funds through debt route. Of course, we don't want to be remaining this way, not having debt on our balance sheet. A reasonable conservative level of debt, which is less than maybe debt equity of 1:1, we will target to achieve. And between these 3 sources, debt, which is significant headroom there, and equity, internal accruals, and of course, HDFC platform gives us quite a bit of ammunition to invest in the pipeline.
Right, and that brings us to the next obvious question. What exactly is the unsold inventory across geographies that you're sitting on? What does that mean in terms of realizable value? Because I'm looking at your presentation from FY22, which suggests that the cash flow that can accrue to the company over the next 3 to 4 years is around 1,500 odd crores.
That's correct. There's a net cash, which obviously is after taking away all the payments required for construction, for the land payments, etc., etc. That's the net cash available after all expenses. Otherwise, the total pipeline or the unsold inventory will be in excess of 3,500 as we speak today, including the projects which are yet to be launched. All in all, the company has a total pipeline of around 22 million square feet at this point in time, out of which 16 odd million has been launched into the market, and 6 million odd is such that all the land, etc., has been tied up or purchased. and they are waiting to be launched pending approvals, etc. So all in all, 22 million square feet of total pipeline, 16 launched and 6 to be launched.
Okay, all right. Mr. Singhal, it was a pleasure speaking with you. Thank you so much for joining us and explaining to us what's working in the Ahmedabad market and for your company as well. And season's greetings to you and the company as well. We'll do one thing with that. We'll move on and talk about a lot more things that we are talking about. So for now, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. While the entire set of broader market is under some pressure, we are focusing on some stocks which are in news today. So let's talk about Spandana Spurti. Is locked in upper circuit after selling stressed loan to an ARC. So it is an outlier today. Abhishek is joining us to tell us more. Abhishek.
Well, MFI continue to sell their stressed loans to ARC, we have seen in the recent past. So, Spandana Spurti has also sold some of its stressed assets to an ARC worth about 323 crores. So, for this, they have received about rupees 95 crore on an upfront basis. This is being done under Swiss Challenge method. And if you take a look, this is one of the best rates that they have got amongst peers as well, who have recently sold their stressed portfolio to ARCs. So Jana Small Finance Bank had sold their stress to ARC. They received about 2.5% in August 2022. Recently, we had Bandhan's news of selling stressed pool to ARC. They received about 9% of the loans. And Spandana Spurti, on the other hand, has received about 29.5% in terms of the pools that they have sold down. So one of the good rates that they have got, and that is why the stock is seeing a massive gain in trade today. Back to you.
All right, Abhishek, thanks a lot for that. That's about Spandana Spurti. But from the broader markets, we're seeing some declines in PVR. I mean, this hasn't been quite the month for PVR, and from the highs, we've seen a cut of almost 25% on that stock already, currently at the low point of trade for that counter. But let's get you some ideas for profit coming in from our colleagues at Money Control Pro. Nitin Sharma joins in with a stock that he's been tracking.
Saregama has maintained a good performance this year across the quarters as it continues to recover from the COVID impact. In the second quarter, it reported Rs 150 crores revenue, highest in the company's history, driven by the licensing and the device sale. 30% EBITDA margin was also in line with expectations. Rising online content consumption with popularity of OTT augurs well for the music IP holders. As more number of ad-supported subscriptions shift to a paid one, Saregama stands to benefit significantly. High engagement of short format videos are also a plus for Saregama, as they typically get half of the ad revenue share. Company management continues to see a 20 to 25% revenue growth and a good margin this year. Increase in Caravan sales are at a higher average price also indicate a good tailwind to the revenue growth. Live event business can also add an upside to the top line. Stock is trading at FY24 P of 37 times and is well insulated from the global macro headwinds. Long-term music streaming / content story is intact, and therefore stock can do well next year. Investors are recommended to add the stock.
All right, Nitin, thank you so much for joining us with that idea for profit. Moving on, the Indian economy saw multiple challenges in 2022, ranging from a spike in energy prices from the Russia-Ukraine war to dealing with the fallout of the Fed's aggressive rate hike trajectory. Sapna is here to take us through the decisions taken by the government to deal with these challenges and also tell us what lies ahead in 2023. Sapna?
The initial impact from Russia's invasion of Ukraine saw Brent crude prices shooting to $130 per barrel, global food supply being disrupted, and inflation soaring. This posed multi-pronged challenges to the Indian economy. With April inflation shocking at 7.79%, the government swung into action. Adding to the freeze on pass-through of crude oil prices to petrol diesel, it restricted wheat exports in May and followed it up with a slew of other measures, including slashing excise on petrol and diesel and doubling the fertilizer subsidy. But as crude prices continued to rise, more was needed. India shrugged off intense global pressure and leaned heavily towards Russia for cheaper crude. So much so that Russia is now the top supplier of crude oil to India, upstaging traditional suppliers like Iraq and Saudi. But the government also cashed in on an opportunity these surging prices threw up. It introduced a windfall tax on oil cos and mandated them to ensure that domestic sales of petrol, diesel and ATF were at least 50% of their exports. Multiple reviews later, the tax remains, even though Indian basket of crude oil has slipped to below $78 per barrel. This is very close to the 2-week average of $75 per barrel, below which threshold the windfall tax should become nil. Indications are the government hopes to garner close to 40,000 crores from this windfall tax by March end. But if the drop in crude oil prices sustain, that number may not hold. In the meanwhile, spike in global inflation prompted the American Central Bank to hike rates aggressively. And this pushed the rupee to record weak levels, from breaching 79 to a dollar on the 5th of July to 83.20 to a dollar on 20th October. RBI's measures to shore up the currency, which included more diversified sources of forex funding and internationalization of the rupee, have had a limited impact so far. The trade deficit continues to widen, crossing $198 billion in the April to November period. Meanwhile, between April and September, India's forex reserves dropped by $75 billion to $432 billion. Since then, RBI has managed to claw back reserves to around $564 billion, providing 9 months of import cover. It was also managed to make some headway on inflation. November CPI has fallen to 5.8%, which is within RBI's tolerance band. However, the rate hikes are taking a toll on the GDP. RBI has now revised the FY23 GDP forecast down from the 8 to 8.5% in the economic survey to 6.8% currently. That notwithstanding, India's economy expanded by 9.7% in the first half, thus continuing to be among the fastest growing in the world. The government has also stuck to fiscal consolidation and not resorted to additional market borrowings, which is a big plus. So, as we move into 2023, the challenges are plain. There's uncertainty over COVID infections, given what's happening in China and elsewhere. There's pressure to maintain growth with fiscal consolidation, even as large parts of the world stare at an impending recession, and of course, keeping inflation within comfort levels while revisiting fuel prices and maintaining a stable currency.
Sapna, thanks a lot for rounding that year up for us. All we can say is 2023, here we come. But until then, we have a couple of days to contend with for 2022. We'll take your leave on that note on Chartbusters. Stay tuned to CNBC-TV18 Trading Hour comes up next.